I'm here again today with Norm Conley, our CEO and CIO on the JAG Exchange. And today we're going to talk about another topic that comes up in conversation. It's been coming up in conversation almost every single quarter related to market concentration. This is especially true within the space that we invest, I think, within Russell 1000 growth and that large cap growth equity space. It's a hot topic. And I think while it's been a challenging environment for many large cap growth investors, I thought we'd take the opportunity to chat with Norm and get some insight on the historical view on this, if we've ever seen anything like this before, or if this is, something relatively new.
James, as you mentioned, this has really been going on. The market has become increasingly concentrated over the last decade. And it now is, so when we're talking about market concentration, we're talking about the percentage of the entire S&P 500, in our case, the Russell 1000 growth, is concentrated into just a few big companies. And it started happening in 2016, 2017. I think I've admitted that back then I thought that it was a real anomaly, and because it was an anomaly, it couldn't persist. And I guess I'm a slow learner. It took me a couple of years to realize that it's not necessarily an anomaly. It's a feature, not a bug, of what has been happening in the capital markets for the last 10 years or so. And by that, what I mean is that especially in technology, and especially in the modern era of technology, most end markets are winner take most. And what you've ended up with is a relatively small cohort of companies that, although they're not legally protected monopolies, they are de facto monopolies in their served markets. Google, which is Alphabet, but Google is the search engine we're all familiar with, is an effective monopoly in the search market. And Apple, while not a monopoly, it is by far the leader in smartphones pretty much everywhere in the world, but arguably in China. The market is more concentrated now than it has been in decades. But when you widen your aperture and you look at the mid, say, 20th century, you had long periods of time where the market was similarly concentrated. You had the General Motors, US Steel, AT&T type of companies that really dominated what we now call the S&P 500 for a long time. In some cases, like AT&T back in the day, they were a legally protected monopoly until essentially the government forced them to break up in the mid-1980s. So again, we don't have legally protected monopolies now, but we do have a small number of gigantic companies that have become de facto monopolies in their served markets and generated enormous amounts of profit and earnings, and they're accorded the valuation which has created this sort of highly concentrated environment. So then the question is, how long will this persist? And my answer is, I don't know. But what I try to do is think about it in reverse. How could the market return to, say, the levels of concentration that prevailed in the mid-2000s? And the answer is, it's math. It would have to be some combination of a decline in value of these mega cap technology companies, which one would presume would be because they start selling less and earning less, and some combination of that, as well as investors or the market as a whole placing higher valuations on companies that are currently smaller. But the math of it is somewhat daunting, especially if you expect this change would occur very quickly, because what we're talking about is several trillions, multiple trillions of dollars of market capitalization shifting from those top 10 companies into the rest of the S&P 500s. Call that the S&P 490. So while it could happen, it's probably going to persist for long enough for it to matter to most investors. So we're not spending a lot of time on our team trying to pick the top in market capitalization. What we want to do is apply our discipline and our process to all the companies that we cover, including the biggest ones. And we think that we can add value that way. I think from a practical standpoint, one of the things we've been messaging to our clients is at least be open, have your mind be open to the possibility that this sort of heavy concentration could persist for quite some time. And if that does occur, we think that clients should and investors should be perhaps a little bit more willing to consider some of the sort of legacy concentration parameters they've put on their portfolio. So that's something that we're messaging to our clients, is that this could go on for a long time. It could even get more concentrated. We've spent a lot of time thinking and talking about AI, and there's a reason multiple companies are racing and spending hundreds of billions of dollars to profit from AI. And the reason is that it is likely that one or a couple or three companies that end up winning this race are going to capture the vast majority of the economics from the entire boom in AI. And obviously that's, I guess maybe it's not obvious, but the rewards will be well into the trillions, most likely. So again, it takes most mindset. Some of these companies could end up being much bigger than they are even now. And if that occurs, the market will be more concentrated in 3 to 5 years rather than less, most likely.
So from a risk management standpoint, it makes sense to at least consider, hey.
We think.
Yeah. All right. Thank you.
Thank you.
That's it for another episode. We'll see you guys soon.